Europe isn't losing money, it's losing the people who create it. Every year, thousands of Europe's highest earners quietly pack a suitcase, hand over their keys, and board a flight not on vacation, but permanently. They're not fleeing war, they're not fleeing poverty, they're leaving because their governments have made a simple calculation that accumulated wealth is a resource to be extracted rather than an engine to be protected. And here's what almost nobody wants to say out loud: the policy is working exactly as designed. Europe is taxing its wealthy, the wealthy are leaving, and the government celebrating these measures will spend the next decade confused about why the revenue never arrives. This isn't a story about greed or injustice or fairness. It's a story about arithmetic, about what happens when you treat mobile capital like it has no other options. And once you see the pattern, really see it, you can't unsee it, because it isn't new. It has happened before, many times, and every single time the ending is the same. In the 3rd century AD, Rome faced a crisis that should sound almost painfully familiar. Decades of military overstretch, a bureaucracy that had tripled in size without producing proportional output, emperors cycling in and out of power so fast that some reigned for less than a year, and underlying all of it, a fiscal gap, a widening distance between what the empire spent and what it could sustainably collect. The Senate's response was to tax the productive class harder, the aura mobilitatium, a forced gift levied on merchants and landowners, the collatio lustralis, a 4-year trade tax applied without exception or appeal, and when those failed to fill the gap, Rome's wealthiest citizens were made personally liable for the tax shortfalls of entire districts. If your neighbors couldn't pay, you could. You know what happened next. The merchant class didn't revolt. They didn't write angry letters to the Senate. They restructured. They moved businesses to provinces where governors were more flexible. They transferred assets into forms that were harder to assess: livestock, buried coin, land on the frontiers. Some simply stopped investing altogether, pulling capital out of productive enterprise and into static wealth that couldn't grow but couldn't easily be taxed either. The Roman historian Lactantius documented what this looked like on the ground: fields left fallow because the tax burden exceeded the value of the crop, craftsmen abandoning trades because the collatio lustralis consumed their margin, entire towns where the remaining population, unable to flee, was crushed under the weight of supporting those who had already left. Now here is the critical insight, the one that makes Rome relevant and not just decorative. The late Roman state did not collapse because it had too little revenue. It collapsed in part because it responded to declining revenue by demanding more from an ever-shrinking productive base. Each demand accelerated the contraction. The contraction justified the next demand. The loop closed tighter each time. That loop has a name. Economists call it the Laffer curve. Historians call it fiscal self-destruction. And right now you can watch it run in real time across Western Europe. 6 stages of fiscal self-destruction. Here is the pattern running live across France, Norway, Spain, Belgium, and the United Kingdom. 6 stages, each one making the next one worse. Stage 1, the wealth tax. Europe's governments face a genuine structural problem. Their welfare states were built for growing populations and expanding workforces. Now the workforce is shrinking and the retired population is swelling. Debt to GDP ratios have climbed past 100%, 120%, 130% in multiple major economies. The politically viable solution is taxing wealth rather than income, because wealth taxes photograph beautifully. They feel like justice. They poll at 70% in every country they're proposed in. France reintroduced property-based wealth taxes under the EFI after briefly abolishing the ISF. Spain extended its solidarity surcharge to net worth above 3 million euros, and Norway made the move that turned a policy debate into a case study. It raised its annual wealth tax to 1.1% on assets above a modest threshold. That means if you own 10 million euros in a private company you've spent 20 years building, you owe 110,000 euros every year regardless of whether the company distributed a single euro of profit. That last detail is the mechanism that breaks the system. Wealth taxes don't tax earnings, they tax existence. Stage 2, the calculation. You are a Norwegian entrepreneur. You've built a manufacturing business worth 14 million euros over 2 decades. It generates 500,000 euros annually in operating profit, which you reinvest. To fund growth under the new regime, your annual wealth tax liability is 154,000 euros. That's 30% of your entire reinvestment budget gone before a single income tax, employer contribution, or VAT obligation is counted. You run the numbers, you open a browser, you search. Way golden visa minimum stay. The answer is 90 days. You search. Cost of Dubai golden visa. The answer is approximately 200,000 euros. You compare that against a decade of Norwegian wealth taxes. The calculation takes 4 minutes. And here's the terrifying part. You are not unusual. In 2022 and 2023, Norway lost more billionaire-level taxpayers to emigration than in the previous decade combined. The government had projected 148 million euros in new wealth tax receipts. The Confederation of Norwegian Enterprise estimated the country stood to lose over 500 million euros in foregone income taxes from the departures, a net fiscal loss from a tax explicitly designed to raise revenue. Stage 3, the crypto acceleration. Now add a second variable, one the framers of European tax policy did not see coming. Cryptocurrency doesn't care where you sleep. A Bitcoin wallet in Oslo holds exactly the same value as a Bitcoin wallet in Dubai, and transferring effective control between jurisdictions takes minutes, not months. For the generation of European wealth created after 2010, the DeFi investors, the EMFT founders, the early Ethereum adopters, digital assets have become the ideal vehicle for capital mobility precisely because they were never fully captured within the European tax architecture to begin with. Portugal was, for a decade, the promised land. Its non-habitual resident regime, the NER, offered a 10-year flat tax structure that attracted thousands of crypto-wealthy individuals from Germany, the Netherlands, and Scandinavia. Lisbon became quietly one of the most concentrated nodes of crypto wealth in Europe. Then in 2023, Portugal began unwinding the regime. It added crypto capital gains taxes. It means tested residency benefits. Within 3 months, searches for Dubai tax residency crypto from Portuguese IP addresses had spiked 340%. Within 6 months, property inquiries in the Algarve from Northern European crypto holders had dropped 40%. This is the feedback loop made visible. Every tightening accelerates the outflow. Every departure shrinks the base. Every shrinkage creates political pressure to tighten further. The loop doesn't reverse, it compounds. Stage 4. The countries that made themselves attractive. Here is what almost no one discusses in the wealth tax debate. Europe is not a monolith. While France and Norway tighten, other European governments have moved deliberately in the opposite direction, and they are winning. Italy, of all places, introduced a flat tax regime for new residents in 2017, 100,000 euros per year, all in, regardless of foreign-sourced income. You could earn 50 million euros outside Italy, pay 100,000 euros, and legally live in Milan. The program attracted over 1,500 ultra-high net worth individuals in its first 5 years, people who brought spending, investment, and ancillary economic activity that more than covered the tax concession. Greece followed with its own 100,000 euros flat tax scheme. Malta built an entire residency architecture around tax efficiency. Monaco remains, as it has been for 150 years, the continent's most brazen tax sanctuary, with a waiting list for residency that reads like the Forbes 400, and Switzerland always. Switzerland continues to offer lump sum taxation negotiated individually with cantonal authorities, a system so discreet and so effective that it has survived every European push for harmonization simply because the Swiss have no incentive to change it. What Italy and Greece understand, and what France and Norway refuse to accept, is that in a world of free movement and digital assets, the competition for wealthy residents is real, it is active, and losing it has measurable fiscal consequences. Stage 5. Dubai and Singapore fill the global vacuum. but for those willing to leave Europe entirely. Two cities have become the default destinations, and they didn't build that position by accident. Dubai operates under zero income tax, zero capital gains tax, zero inheritance tax, and zero wealth tax. This is not a loophole or an oversight, it is a deliberate national strategy, the way government understood 2 decades ago that the commodity most worth attracting in the 21st century is not oil, it's human capital, specifically the kind of human capital that generates economic activity, employs other people, and multiplies in value rather than depleting it. The way processed over 100,000 golden visa applications in 2023 alone, the dominant nationalities: British, French, German, Italian, in that order. Singapore takes a more sophisticated approach. It taxes local income modestly, exempts offshore earnings almost entirely, and has constructed legal, financial, and regulatory infrastructure that makes domiciling a global business there genuinely functional, not just fiscally advantageous but operationally compelling. Its ultra-high net worth population grew 7% in 2023. France lost an estimated €2 billion in taxable wealth to outmigration in the same period. This is not money hiding in numbered Swiss bank accounts. This is productive human beings, with businesses and employees and spending patterns, simply choosing to live somewhere that doesn't punish them for building things. Stage 6. The revenue paradox. Here is where the arithmetic becomes cruel. Wealth taxes consistently fail to collect what they promise. The mechanism is structural. Liquid wealth moves. Illiquid wealth, property, domestic businesses, physical infrastructure stays behind and pays, but illiquid wealth is often the least capable of paying without forcing a sale. You cannot pay a €150,000 annual levy from a factory that reinvests its profits without either taking on debt or selling assets. Many owners, facing that choice, choose a third option: change their address. France's original ISF, the solidarity tax on fortune, was analyzed by the Institut Montaigne and found to have cost France more in foregone revenue than it ever collected. Each euro raised directly prompted roughly €2 of capital relocation. Spain's solidarity surcharge has been challenged in court by regional governments that refuse to enforce it, and Norway is already revising its projections as departures continue to outpace the Treasury's models. The tax was designed to correct inequality. What it actually corrects is the residency decisions of the mobile wealthy. Inequality stays. The wealthy leave, and the Treasury is quietly, reliably worse off than before. If you want to understand why the next decade of European politics is going to be more volatile than anything in living memory, subscribe, because what we just covered is the opening act. The next video covers what happens when governments that have already lost their tax base start looking for new revenue sources, and who exactly they find. What 2035 looks like from here. By 2035, none of this will feel like a crisis. It will feel like normal. The wealthy districts of Paris will still be beautiful, the restaurants will still be full, the art will still be extraordinary, but the composition of the people inhabiting that city will have quietly shifted: more Gulf state visitors, more American expats, more people who arrive to consume rather than to create. The productive base that sustained the tax receipts that funded the culture will have thinned in ways that are invisible on a tourist's map but catastrophic on a finance minister's spreadsheet. The French government will have raised taxes again to compensate for declining receipts, not on the wealthy, who will increasingly not be there, but on the upper middle bracket, the architects, the senior managers, the doctors, the engineers, people too rooted to leave easily, with mortgages and children in school and aging parents who need weekly visits. They will pay not only for their own welfare state but for the welfare state vacated by those who departed. Their resentment will be quiet at first, then it will not be. In Germany, the Mittelstand, the medium-sized family businesses that constitute the bedrock of German industrial output, will face a succession crisis accelerated by inheritance tax structures that make passing a company to the next generation more expensive than selling it to a foreign buyer. Many will sell. The buyers will be American. private equity or Asian sovereign wealth funds. The jobs initially will stay, the strategic decisions will not. In the United Kingdom, the abolition of the non-domiciled resident tax regime in 2025, a decision that had been building for years under pressure from politicians who found the concept politically intolerable, will have triggered an exodus of several thousand ultra-high net worth individuals. The Treasury projected modest gains. Analysts at Oxford Economics projected a net fiscal loss. By 2027, the data will have settled the argument. The question is whether anyone in government will acknowledge what it shows. And underneath all of this, a political shift already well underway will accelerate when the working-class voters who were promised relief from wealth taxes discover that those taxes failed to fill the treasury, while the billionaires they were aimed at are paying €100,000 flat taxes in Milan or zero taxes in Dubai. The fury will not be philosophical, it will be electoral. You can already see it moving through the ballot results of France, Germany, Italy, and the Netherlands. The direction is unmistakable. The question is only how far it travels. Here is what the debate about wealth taxes almost never addresses. The moral case for taxing accumulated wealth is not frivolous. Research on wealth concentration and political capture is substantial, credible, and troubling. The argument that societies function better when capital is broadly distributed rather than tightly concentrated in a small class is supported by history, by economic evidence, and by something most of us feel intuitively when we look at the gap between what exists and what is possible. That argument deserves to be taken seriously, and then it deserves to be asked a harder follow-up question. What does a society look like when it successfully drives out the people who accumulate capital but fails to change the underlying conditions that produced inequality in the first place? When housing is still unaffordable because planning restrictions remain untouched, when small business formation is still suppressed by regulatory burden, when wages for the bottom half are still held down by labor market structures that predate the wealth tax by 40 years. The answer, drawn from every historical parallel from late Rome to 1970s Britain to modern Venezuela, is consistent. A society with measurably less total wealth, structurally unchanged inequality, and far fewer fiscal options for addressing either. The wealthy didn't take the money, they took themselves, and in the knowledge economy, in the era of digital assets and remote management and golden visas, yourself is the most mobile thing you own. Europe is not making a mistake in the way policymakers make mistakes through ignorance or incompetence. It is making a choice, a coherent, politically logical, democratically mandated choice. The question is whether anyone in the rooms where those choices are made is willing to be honest about what they have decided to sacrifice in exchange for what they have decided to keep. The money didn't disappear, it just changed its address.